Hi everyone, in this video we are going to discuss the questions which are there in the RTP for the past three attempts in the subject of financial reporting for CA final. Okay, so let's make it into some parts so that it will be easier for us to revise quickly. And one thing will be like the big sums will be like consolidation and business combination. Those will be dealt separately, and those will not be handled here. But all the small questions, all which are tricky, those all will be covered. This will be our agenda. So before the May 2023 attempt, let's try to cover all the RTPs and MTPs which are there for the G1 of CA final. So setting this as agenda. So let's move on. So the first topic would be the framework for presentation of financial statements. Give me a minute. I will just make it some more. Zoom it some bit. Okay, yeah. Defense Innovators Limited as a public sector undertaking is engaged in the construction of warships and submarines. XYZ Private Limited approached Defense Innovators Limited for construction of a specially designed ship for its which will be used by XYZ Private Limited for the transportation of specific goods. The offer was accepted. Construction and delivery of specially designed ship fixed price basis with a variable component with respect to certain terms. Base and depot spares for all three ships shall be procured from Defense Innovators Limited and will be paid on the cost of the item with a certain percentage. The contract states that certain equipment out of variable cost items will be supplied by XYZ Limited at free of cost for installation on the board of the ship. It is therefore to be noted as some equipment are procured by Defense Innovators Limited in the presence of XYZ Private Limited as a representative for technical scrutiny as well as negotiating. The vendors of this equipment are paid by the Defense Innovators Limited, and the cost of the equipment along with the cost of installation and profit thereon is claimed and reimbursed by XYZ Private Limited to Defense Innovators Limited. Okay. Then there are certain other equipment for which orders are directly placed and also paid by the XYZ Private Limited. These equipment are known as buyer furnished equipment and delivered to the company free of cost for installing the ship. The labor cost of the installation are already included in the price component of the contract. BFEs are buyer after completion of the ship. The period required for construction of one ship is approximately 4 years. Whether these bio-furnished equipments applied by XYZ Private Limited to Defense Innovators Limited for installing the same in the ships can be recognized as inventory by Defense Innovators Limited, and then on delivery of the ship will be recognized as revenue in the books of account. Elaborate. Okay, now that we have read the entire question, some of us might have felt it boring. So let me repeat what is the crux of this question. Okay, here there are two companies: Defense Innovators Limited, which is the public sector undertaking, and it is in the construction of ships. Okay. Similarly, there is a company XYZ Private Limited, which is approached for the construction of special design ship to the Defense Innovators Limited. So Defense Innovator will be supplier here, and the XYZ is the buyer here. Okay, clear? And this offer is accepted, and there is an agreement which there is a fixed price and also a variable component is there. Okay, so the now it is said that you will give me some cost plus certain percentage. Okay, and certain equipments will be supplied directly at free of cost for the installation. Okay, the point number one states that some equipments will be directly procured, okay, by the defense innovators, but XYZ will be paying it. Okay, sorry, defense innovators will be paying it. Okay, but this plus some profit will be claimed and reimbursed. Okay, this will be the first one. Second was equipment is directly supplied. The buyer will directly pay to the other one supplier. Okay, see, I'm going to defense innovators going to purchase from say ABC Limited. So XYZ Limited will be directly paying to ABC Limited. Okay, so that will be known as buyer furnished equipment. Okay, let's move on to the answer. Okay, here before any see item can be recognized as inventory, it should meet an asset, right? Because it is a conceptual framework. First, according to Indias, whenever you are going to charge any item as a liability or something as an recognized as an asset, then that should first meet the definition which is set out in the asset and liability standard, unless there is specific exception. Now, almost all exemptions have been exceptions have been revamped, and the entire standard have been revamped in some cases. Okay, there will be amendments in certain cases to match with the conceptual framework. So given this as a point, now first a thing has to first qualify as an asset. Okay, then only then it can be further classified into inventory or PPE likewise. Okay, so first this biofurnished equipment has to be first qualify whether it is an asset. Okay, only then you can check whether it is an inventory. So asset, what does an asset mean? Asset is a present economic resource controlled by an entity as a result of past event. An economic resource is a right that has a potential to produce future economic benefit. The orders in respect of biofurnished equipment are directly placed by the buyer, and payment is also made by the buyer. So here in our case, XYZ Private Limited places the order for the biofurnished equipment, and also it is paid by the XYZ Private Limited. These are then supplied to the company for installing the ship, and the buyer pays the installation charges which are included in the contract price. See, then this coach is supplied free of cost to the Defense Economics Limited, and for the labor cost you're going to recover it, right? Then also by places the installation charge. The company has neither incurred any cost nor amount is recoverable. The Defense Innovators Limited has not incurred any cost. Okay, the first question is that whether, see, here it is inventory by Defense Innovators Limited. So I have to check from the perspective of the books of accounts of Defense Innovators Limited. Is Defense Innovators Limited going to pay for that equipment? No. Buy first equipment? No. Who is going to pay? XYZ Private Limited. Okay. Second point is uh, Defense Innovators Limited has a right to recover some amount towards it. No, because all the installation charges, everything is paid directly to that XYZ, I mean the other party. Okay. Accordingly, such equipment and are not assets that may be considered as a part of contractor's work in progress. In fact, after installation of the ship, BFE are returned to the buyer. I mean, I'm not going to keep it. We have a point there. BFEs are returned to the buyer after completion. So I'm not going to keep it with me. Then how could I classify it as an asset? Okay. Then, because it is held in the capacity of Bailey, it isn't held in the I'm just holding it on trust basis, Bailey basis, and not on. I'm not the owner. Since it cannot be classified as an asset, it can neither be considered as an inventory or work in progress. Further, can also not be considered as a part of sale value or revenue of the company, as no consideration will be receivable with respect to the cost of such equipment. BFE cannot be considered as inventory since I'm not going to recover any amount towards it. It cannot be considered as a part of sales value or contract value. It's like one of the different questions which have been raised in the RTP. So it's quite important. Okay, now that the conceptual framework has been entirely revamped, so again this becomes quite important area. So I hope you have understood. So like this, we will discuss only the important sum, so that like the other point of time saving is also to be considered, right? So not every question can be discussed. So next question is, here. Fresh Vegetable Limited was incorporated on 2nd April 2021 under the provisions of the Companies Act 2013 to carry on the wholesale trading business in the vegetables. As per the audited accounts of the financial year 2017, approved on the AGM held on 31st August, its net worth of the first time incorporation exceeded 250 crores. So this means I'm going to apply in the yes, right? I am a limited company, public company, and maybe a listed or unlisted. Okay. The financial statements since inception till the financial year ended 2016 was prepared in accordance with AS. It has been advised to prepare under in the AS. The following additional information is being provided. FEL's financial year entered into 60/40 partnership with the Logistic Limited and incorporated a partnership firm PLA to carry on the logistic business of the vegetables from farm to market. FPL also has an associate company. It is a company, Social Welfare Limited, but the other one was partnership. Vegetable Logistic Associate was a partnership firm. Now, this is a Section 8 company. Okay. Now, I have to check the applicability of IND-AS. So, what is the applicability of IND-AS? So, to whom all IND-AS is applicable? Should I zoom it further? I think it would be better to zoom, right? Okay. I think this is quite visible to you all. Okay. Yeah. Applicability of IND-AS. What is the general provision? All companies which are listed and then unlisted company having a net worth of 250 crore or more but less than 500 crore. This was from some dates, right? And then holding subsidiary associate of a joint venture and above. Companies listed on SME exchange are not required to apply in the AS. Once a company starts following in the AS, either voluntary or mandatory, it shall be required to follow in the AS only and it cannot come back. Application of Ind AS for both standalone financial statements if threshold criteria are met or adopted voluntarily. Even though I adopted voluntarily or mandatory requirement, I have to apply it both to the standalone and the consolidated financial statement. Companies meeting the threshold for the first time at the end of the accounting year shall apply the next accounting year with the comparatives. Assume I am fulfilling the only on 31st March. Then there is a relaxation given, so I could follow from the immediate next accounting year along with the comparatives. Okay, companies not covered by the companies not covered. I don't know what happened. Just give me a minute. Not covered by the above roadmap shall continue to do with the AS. Okay, since the net worth of FPL and the immediately preceding your exceeded 250 crores in this will be applicable. Now I have to examine for the both cases. First, that I have to mention, okay, whenever there is an in the related question which states for applicability, the first point I have to write is about the applicability and how it applies to the current entity. Okay, then if there is a similar question is asked like VLA and SWL, two related parties are given, I have to check for them. Then I have to put an heading, okay, instead of like I have to put the heading as VLA. Then I have to discuss about the related points. Then SWL. This improves the presentation and this makes it easy for the examiner to understand it. So small tips I will give. Okay, it's not that this is a short tips, but these are things which I have followed. Okay, don't think that I'm an anchor. Nothing like that. Don't just follow blindly with someone's perceptions. Okay, you just go. You think yourself as an examiner and what you will expect you present in the paper. Okay, as a student. Okay, then joint arrangement can be either a joint operation or a joint venture. However, for the purpose of identification of applicability, identifying the applicability, Act defines joint venture means a joint arrangement whereby the party have a joint control of the arrangement that have a right to the net assets. See, joint venture would have a right, joint control, and plus a right to the net assets. Accordingly, if an entity is classified as joint operation and joint venture, then in the AS would not be applicable to such entity. See, in the joint arrangement, there are two things. One is joint operation, other one is joint venture. Only for joint venture, the Ind AS applicable based on the related applicabilities, and for joint operations it's not applicable, right? In the case of VLA, if the partners conclude that they have a right in the assets and obligations relating to the partnership firm, then this will be a joint operation. Okay, then in this will not be applicable. Okay, not applicable in the case of joint operation. Alternatively, if the partners conclude that they have a joint control and they have a right to the net assets related to partnership firm, then in this should be applicable to them. Okay, so see, there is no full information given in the question, so you have to put your assumption there. That is very, very important. Working notes and assumptions are very important at CA final level. Please don't mix your marks here. Writing your answer, doing only the calculation is not sufficient at CA final level. So I have scored 81 in FR. That's because I have given all the working notes which is relevant. Okay, so then you can't ask me why you didn't score 100. That's quite okay. I have got only this much. Okay, I'm sharing with you. That's fine. Okay. So if it is a joint operation, then Ind AS will not be applicable. If it is a joint venture, then Ind AS should be applicable. Then SWL, then Ind AS should be applicable. There is no exemption for Section 8 company. Okay, that's what they have given. Then if it is falling under the definition of associate company, then November 22. All the November 22 questions we will discuss. Okay, can be rest assured for that. Okay, as per statutory requirements, exceptional items are to be disclosed, whereas in the AS1 requires separate disclosure of material items and how these are to be presented in the financial statement. Does this imply exceptional items? Exceptional means material. Give examples. How should these be presented in the financial statement? This is quite simple, but tricky, right? So in the US, we don't have a concept called extraordinary. Okay, from the standards perspective, all the things which are happening in a business is ordinary. Okay, there is nothing called extraordinary. Okay, there could be some cases which are exceptional, but not extraordinary, which is not superior, but it's like generally it will not happen. There has been a strange change. That is known as exceptional. Okay, exceptional items have not been defined. Okay, it's not defined, but it's based on it's subjective. That is not. It is based on the understanding of the users or the preparator, preparing person. Okay, However, paragraph 97 of the India's one requires that items of income and expense material and entities should disclose the nature and amount separately. As per India's one, information is material. If omitting, misstating, or obscuring it could reasonably be expected to influence the decisions that the primary use of general purpose financial statement make on the basis of post financial statement, which provide financial information about a specific reporting entity. Materiality depends on the magnitude or nature or magnitude of the information or both, and it could be the determining factor. When items of income and expense within the profit or loss from the ordinary activities are of such nature and size or an incident that their disclosure is relevant to explain the performance of the enterprise for the period, the nature and amount of such items should be disclosed separately. Generally, items of income or expense fulfilling the above mentioned criteria are classified as exceptional items and are disclosed separately. From the above, it appears that all material items are not exceptional items. In other words, exceptional items are those items which meet the test of materiality and the test of incidence. Okay, see, when something is different from the normal activity that requires a disclosure because of the nature of the incidents, okay, so it is fulfilling both the condition of test of materiality and test of incidence. That's why it's coming as an exceptional item. That's why all material items are not exceptional item, but all exceptional items could be material items because if they fulfill the test of materiality and test of incidence. Okay, so, what could be the examples of exceptional item? Write down of inventory, okay, or reversals. Write down of inventory or PPE or its reversal. Then restructuring activities and its reversal. Disposal of PPE, disposal of investment, discontinued operation, litigation settlement, other reversal of provision. Let's repeat it once again, okay. Write down of inventories of PPE or its reversal, restructuring activities and its reversal, disposal of items of property, plant and equipment, investments, discontinued operations, litigation settlement, and other reversal of provision. Other reversal of provision. So let's move on, right? A bit slow, but let's move on. Okay. PQR Limited prepared its interim financial statement. So it is interim financial reporting standard. Okay. Now, for the quarter 3 of the year, how the following transactions and events should be dealt while preparing its interim financial statement. Okay. It makes employer contributions to government-sponsored insurance funds that are assessed on the annual basis. During the quarter 1 and quarter 2, larger amounts of payments for these contributions were made, while during the quarter 3, minor payments were made. Okay. So contribution is made up to a certain maximum level of earnings per employee. Higher income employees, the maximum income reaches before the year end. It makes employer contributions to government-sponsored insurance funds that are assessed on annual basis. During quarter 1 and quarter 2, large amounts were made, and during quarter 3, minimum payments were made. Okay, so let's first discuss this, okay? If the employer contribution to government-sponsored insurance funds are assessed on annual basis, the employer expenses are recognized using the estimate of annual effective contribution rate in its interim financial statement, even though a large portion of the payments have been made early in the financial year. Accordingly, it should work out an effective contribution rate and account for the same accordingly in the interim financial statement, which is nothing but, say, assume we are paying 15% contribution on an annual basis, then should be divided by 4 quarters, right? Divided by 4. And every quarter, 3.75 percentage will be charged as expense, okay. It is not based on actual contribution, but on the uh, basis of the average effective contribution rate. Okay, the second question. The entity incurs a major repair and renovation expense of the office building. For this purpose, it has started seeking quotations from various vendors. It has also tentatively identified a vendor and expected cost that will be incurred for this work. Okay, I am going to incur. Okay, see here. The cost of the planned overall expenditure that is expected to incur in the later part of the year is not anticipated, for the interim reporting period unless an event has caused the entity to have a legal or constructive obligation. The mere intention or necessity to incur the expenditure is not sufficient to give rise to an obligation. Mere intention is not necessary, but I have to have a valid legal or constructive obligation. Mere intention is not necessary criteria, but I have to have a legal or constructive obligation to set out the expenditure, recognize the expenditure. Now let's move on. The company has a practice of declaring 100% 10% bonus. Sorry. 10% bonus of annual operating profits every year. It think so because it has cleared a constructive obligation, right? So let's see the answer. A bonus is anticipated for interim reported purpose only if and only if the bonus is a legal obligation or a past practice would make the bonus a constructive obligation, legal or constructive obligation. Here it is a constructive obligation. A reliable estimate of the obligation can be made. In this 19, employee benefits provide guidance in this regard. A liability for bonus may arise out of legal agreement or constructive obligation in because of which it has no alternative but to pay the bonus. Bonus liability is accrued in the interim financial statement on the same basis as they are accrued in the annual financial statement. In the instant case, bonus liability of 10% of operating profit for the year to date may be accrued in the given case. Since the company has the past record of declaring the annual bonus every year, the same may be accrued using a reasonable estimate while preparing the interim financials reporting, which means for the current period, based on my reasonable basis estimates, I have to estimate 10% of operating profit as bonus and accrue the same because I have constructive obligation because it has created a want in the minds of the employees, okay, because of my past practice. Till now we have completed that. In their 7 cash flow statement, the first one is simple, what we actually do in a direct method. Okay, there's no big thing in there. Okay, here, what will be the classification of the following item? What will be the classification of the following item? Oh, let's see it. Interest received on loans and advances for banks and financial institutions. Okay, first let's discuss about other entities, and for banks and financial we'll come back. Okay, interest received on loans and advance given. Investing activity. Deposits and other borrowings paid. It is paid. So it is a financing activity. Dividend received, again, interest investing activity. Dividends paid, financing activity. Finances paid, financing activity. Payment towards reduction of outstanding finance lease liability. Lease is a financial obligation, right? So it's a financing activity. It is like I have obtained a finance by way of lease. Then interest paid to vendor for acquiring a fixed asset under deferred payment basis. This is a financing activity because I have, like, it is a kind of financing agreement arrangement. Principal sum payment under the deferred payment basis. Investing activity for acquisition of fixed asset. This is quite important. Okay, so what will think, we will again think it as a for financing arrangement. Principal sum payment. There's a principal, not interest. Principal sum payment under the deferred payment basis for the acquisition of fixed asset. Penal interest received. Penal interest received from customers for late payments because of operating activity. For suppliers for late payment, again, it's an operating activity. Delayed tax payment is an operating activity. Generally, tax expense will be classified as operating activity unless specifically mentioned. Interest received on tax refund. Operating activities. Okay, let's see it for the finance, bank and financial institution. For them, the major business itself is giving and receiving money, right? I mean, giving loans, receiving deposits. So, received on loans, operating activity, paid on deposits, operating activity. Dividend received will be from the investment, that will be known as investing activity. Equity shares will be known as dividend paid, will be known as financing activity. Lease, financing activity. Rest all is same, right? Almost. Let's check. Almost rest all same. Okay, then let's move on. Revenue from contract with customer. This highly important question. If you have not watched the video of which is there for India's 115 in our channel, please do watch it because it's highly important. Very, very important. I'm stressing it very much because it's like some startup is very much essential for every company which is there operating. Because without revenue, what is the main purpose of doing a business? To generate revenue and earn profits. So this stuff is highly important, high importance. Okay, top one. Okay, see, financial instruments also you will just do it for recognition, subsequent measurement. That will be there. This on day basis you have to do this one revenue. Okay, so this is high important. Okay. Prime limited yes, H hardware and accessory A. Standalone selling price of these items are 50,000 software, hardware 1 lakh, accessory 20,000. Okay. Since the demand for hardware H and accessory A is low, Prime Limited sells A, H and A together at 1 lakh. A together at 1 lakh. It is in a contract with Zeta to sell all the 3 items for 1 lakh 50,000. What will be the accounting treatment for the discount in the financial statement of Prime Limited considering 3 items or 3 different performance obligations which are satisfied at different points of time? Okay. Further, what will be the accounting treatment if Prime Limited would have transferred the control of H&A at the same point of time? Okay. So, before we move on to this question, actually, we will just first recollect what is the provision or the principle. To be honest, it's a principle. An entity shall allocate a discount entirely to one or more, but not all performance obligation in the contract if all of the following criteria are met. The entity sells each distinct goods or service in the contract on a standalone basis. The entity also regularly sells on a standalone basis a bundle of some of these goods at a discount. The discount is attributable to each of the bundle. See, here it is. I'm going to allocate to one or more, but not all. Okay, this is important keyword. Okay, why this principle is discussed here, I'm connected you. Okay, then the discount attributable to each bundle of goods or services described is substantially the same as the discount in the contract, and analysis of the goods or service provides an observable evidence of the performance obligation to which the entire discount in the contract belongs. In the given case, the contract includes a discount of 20,000. Okay, so let's come back here. 50,000 plus 1 lakh, 1 lakh 50,000, 1 lakh 70,000. But I'm going to sell all these three items at 1 lakh 50,000. Okay. Now, and I know other thing is these two products, 1 lakh 20,000 worth products, I'm going to sell at 1 lakh 10,000, 1 lakh regularly. So it means the discount of 20,000 is attributable only to H&A because software. See, the difference between these two prices is 50,000 is the standalone selling price of software. There is no discount. It's attributable to software. Yes, that is the conclusion first. First conclusion. Okay. Second conclusion is the amount of discount which is to be charged. Okay, let's move on directly to that area. Okay. Here, see, 20,000 discount is there. So 1 lakh divided by 1 lakh 20,000 into 1 lakh price divided by the consideration of this obligation divided by the standalone, total consideration that have been received. Okay, 20,000 divided by 1 lakh 20,000 into 10,000. This is the transaction price. The rest amount will be known as discount. Rest amount will be known as discount. Okay, here for it is a discount of 16,067. Here it will be around 3,000 odd. Okay, now let's move on. On 1st April 20X1, S Limited enters into a contract with Corp Limited to construct a heavy duty equipment for a promised consideration of with a bonus of rupees if the equipment is completed within 24 months. At the inception of the contract, S Limited correctly accounts for the promised bundle of goods as a single performance obligation. At the inception of the contract, the company expects the cost of to be rupees and concludes it is highly probable that significant reversal in the cumulative amount will occur. Significant reversal will be occurring. Completion of the heavy-duty equipment is highly susceptible to the factors outside the company influence, mainly due to difficulties with the supply of components. At 31st March 20X2, X Limited has satisfied 65% of its performance obligation on the basis of the cost incurred to date and concludes the variable consideration is still constrained in accordance with the Ind AS 115. However, on 0x2, the contract is modified with the result that the fixed consideration expected cost increased by 1,50,000 and 80,000 respectively. The time allowable for achieving the bonus is extended by 6 months, and it is highly probable the bonus will be achieved now. Okay. So, what is the treatment, accounting treatment? So, for the 20x1, what is the case is I have the promised bundle of goods. Okay. So, transaction price is 20 lakhs. Expected cost is 11 lakhs and expected profit is 9 lakh 2,000. Excludes 2 lakh 2,000. I'm not going to recognize it because it's highly probable that I'm going to see. When I will recognize a variable consideration, only when it is not probable that significant reversal will, okay, when it's highly probable that the significant reversal will not occur, okay, when it is highly probable that the significant reversal will not occur, okay, but in our case, it is highly probable that the significant reversal would occur. That's why I'm not going to recognize this bonus at the initial stage. But at the end of the first year, the entity has satisfied 65% of the performance obligation. The cost to date was 7,50,000. So it reassessing. So 13 lakhs, because I've satisfied 65%, 13 lakhs, cost will be 7,50,000 and profit will be 5,85,000. On 4th June 20X2, the contract is modified. As a result, the fixed consideration expected cost is increased by 1,50,000 and 80,000 respectively. The total potential consideration would be how much? 20 lakh plus 1,50,000, 21,50,000 plus 2,50,000 because I'm sure that I have the probability of achieving the variable consideration is high. That's why I'm going to recognize it. So 2,50,000. So it is 21,50,000 fixed consideration plus 2,50,000 completion bonus. In addition to this, allow for achieving is also extended by 6 months, which makes it highly probable that the bonus will be recognized, received. Okay. Contract remains a single performance obligation. Okay. So 60.6% has been completed now. Okay, additional revenue will be recognized to the extent of 6% of 24 lakh less 13 lakhs revenue recognized till date. That will be the additional revenue. Okay, that is to the extent of 1,54,500. Okay, this will be known as catch up adjustment. This will be known as catch up adjustment because it is a single performance obligation before and now also. It will be known as like modification of the original contract itself. That's fine. We account it as a catch-up adjustment. Okay. Now let's move on. 22%. A limited owns. See, May 2023 that will be discussed separately. Okay. For now, till November 22, we'll be discussing. Okay. A Limited owns 20 resorts across India. Every customer who stays in any of the resorts owned by A Limited is entitled to gain at a point on the basis of total amount paid by him. Under the scheme, 1 point is granted for every 1,000 rupees spent for stay in the resort. As per the past experience, A Limited, the likelihood of the excess of the points is 100%. And standalone price for each point is 5 rupees. Customer expends 10,000 in one of the resorts of A Limited. What is the accounting treatment for the points? See, it is highly probable that it will be exercised. 100% probability. Okay. So, if the contract in an entity grants a customer an option to acquire additional goods or services, that option gives rise to separate performance obligation only if it provides a material right to the customer and it will not receive without entering into the contract. Okay. It states that if the customer has an option to acquire additional goods or services at a price that would reflect the standalone selling price of that good or service, that option does not provide a customer with a material right, even if the option can be excised only by entering into the previous contract. In those cases, see, let's repeat it again. If a customer has an option to acquire additional goods or service at a price that would reflect the standalone selling price for the good or service, that option does not provide a customer a material right, even if the option can be excised only by entering into a previous contract. In those cases, entity has made an marketing offer that it shall account for in accordance with standard only when the additional goods or services. In the given case, the customer does get a material right. Okay. In effect, pays the entity in advance the future goods, and the entity recognizes revenue when the goods are transferred. See here. Okay, let's go directly to the conclusion before we come back. Okay. In the current case, standalone selling price of 100 basis point is 500. Okay. A should allocate the fair value of consideration between the points and other components of the sale. So 500 divided by 10,500 into 10,000. 10,000 divided by 10,500 into 10,000 respectively in the proportion of standalone selling price. Since A applies the award itself, it should recognize the revenue of when the points are redeemed. Okay. So let's understand it. Okay. Now, let me clear all the doubts in your mind. Okay. What happens is that if I spend 10,000 rupees, okay, for every 100 points, I'm going to get 1 point. Okay. 1 point value is 5 rupees. Okay. Here I would have 10 points. Okay. 10,000. 100 points. Okay. 100 points. Okay. 10,000 divided by 100 is 100 points. That each point would value 5 rupees. So 500 rupees is my, my grant. Okay. Under the scheme. So there is a high likelihood that I will be excising. If with standard teaches, if this is just a marketing offer, you should not recognize it. But here it is granting a material right to the customer. I'm going to recognize it as a revenue. What I'm going to do is this 10,000 is received not only for the current stay but also towards the grant scheme. That's why I'm going to allocate to the what is the total consideration that should have been received 10,000 plus 500. So 10,500. So I have received only 10,000. So I'm going to portion this 10,000 to 500 and 10,000 respectively. So 10,000 divided by 10,500 into 500 towards the scheme and 95 towards the actual revenue. This 476 will be recognized as a revenue only when the points are redeemed. Till that it will be kept as an advance payment. Till that it will be kept as advance payment. Okay. Then in this 8, only one question is there. Let's focus it good. Okay. No. While preparing the interim financial statement for the half year ended 30th September 2021, entity notes that there has been under accrual of certain expenses in the interim financial statement for the first quarter ended 30th June 2021. The amount of under accrual is assessed to the material in the context of interim financial statement. However, it is expected that the amount would be immaterial in the context of annual financial statement. The management of the opinion that there is no need to correct the error in the interim financial statements, considering the amount is expected to be immaterial from the point of view of annual financial statement. Whether the management's view is acceptable, it is okay. What does it state? There is an error. Okay, identified in the interim financial statement. The management says that this will be immaterial from the point of view of annual financial statement, and it is unwilling to correct. Okay, and so view that there is no need to correct it. Whether this view is acceptable. What is your view? Seeing answer. Let's try it out. Correct it. Whenever there is an error, we have to correct it. Right? 41 of India's inter alia states that financial statements do not comply with Indias if they contain a material errors or immaterial errors made intentionally to achieve a particular presentation of an entity's financial position, performance, or cash flow. As regards to assessment of materiality, in interim financial statement states that while judgment is always required in assessing materiality, this standard bases the recognition and disclosure decision on the data for the interim period by itself for the reason of understandability of the interim figure. Thus, for example, unusual item changes in accounting policies, errors are recognized, disclosed based on materiality in relation to interim period data to avoid misleading inferences that may result from non-disclosure. See, materiality is with regard to the particular reporting period. Okay, if you're doing it for annual basis, then it will be for annual. If you are doing it for interim period, then it will be for interim. This is to achieve the fair presentation and not to mislead the users. Okay. The overriding goal is to ensure the interim financial report includes all information that is relevant to understanding of entity's financial position and performance in the interim period. As above, when material judgments always involve a degree of subjectivity, the overriding goal is to ensure the interim financial report includes all the information that is relevant to the understanding of the financial position. Okay. It is therefore not appropriate to base a quantitative assessment of material on projected annual figures. Accordingly, this is the final conclusion. The management is required to correct the error in the interim financial statement since it is assessed to be material in relation to the interim period data. Okay, let's bring it again. Okay, what is the conclusion here? How we have to write it? First, we have to mention the principle. Okay, then we have to apply it in the current case, and then we have to move it to single line conclusion, one line conclusion. Here it is like the management is required to correct the error in the interim financial statement since it is assessed to be material in relation to the interim period data. Okay. Let's complete this fair value standard with, and we'll find up this video. Okay. Yeah. On 1st January 20x1 assumes a decommissioning liability in a business combination. The reporting entity is legally required to dismantle and remove an offshore oil platform at the end of its useful life, which is estimated to be 10 years. The following information is relevant. If A was contractually allowed to transfer its decommissioning liability to a market participant, it concludes the market participant would use all of the following inputs, probably weighted as appropriate when estimating the price it is expected to receive. Labor cost, okay, cash flow estimates, probability, okay, cash flow estimates and the probability. Labor costs are developed on the basis of current marketplace wages, adjusted for expectation of future wage increase, required to hire contractors to dismantle this and remove this offshore. Decommissioning liability, okay. Allocation of overhead cost, 80% of labor cost. The compensation that the market participant would require. Profit on labor cost, 20% markup is consistent. Okay. Then risk that the actual cash flows might differ from those expected, 5% premium. Then effect of inflation, 4% over 10-year base period. Time value of money, risk-free rate, 5%. And then non-performance risk, that is own credit risk, 3.5%. A concludes that the assumptions would be used by the market participants. In addition, A does not adjust for any fair value measurement for existence on restriction, preventing it from transferring the liability. Now I'm going to calculate the retirement obligation. Okay. So first, the expected labor cost. We have to apply the probability and get the expected cash flow. Apply the probability and get the cash flow. That will be the first expected labor cost. Okay. Then allocated one is 80%, right? So I'm going to put 80% on this amount, one not 5%. Profit. how much profit I'm going to earn. It has been given that the profit is 20% markup. Okay, so what are my costs? Okay, these are my costs, so I'm going to put a 20% on this. Okay, then this will be my expected cash flows. Okay, inflation factor for next 10 years is 4%. So 1.04 to the power 10. Expected cash flows adjusted for inflation 283 into 1.4. This is the adjusted cash flows with covering the inflation. Then risk adjustment uncertainty relating to the cash flows is 5%. This is for the risk rate. Sorry, one just a minute. Risk adjustment. This is for the premium. Okay, this is the premium which is going to be paid. Okay, this will be total cash flows. What is the expected cash flows? Expected cash flow will be my risk free rate and the company entity's own risk premium, right? So 5% plus 3.5%. This 5% is confusing, right? So let me make it very simple for you. Okay, let me take it here. Okay, first what I will do is for step one, calculate the cash flows. Okay, which is nothing but labor cost plus overheads plus the markup profit. It's nothing but the profit. Okay, then step 2. Okay, adjust for inflation and risk adjustment. That there could be some estimates, wrong estimates in the cash flows, right? So that is known as the risk factor adjustment. Okay, it's nothing but inflation adjustment is F2. Inflation adjustment is how much? 4%. 4% for a period of 10 years. Okay, 10 years. And then risk adjustment would be, I'm going to put 5% additionally. Okay, here it's like I see. For example, assume that I have mentioned as 100 rupees. Okay, it should, the risk that there could be 95 or it could have been 105. Okay, there is a 5% chance that it could be either less or more. That is known as risk adjustment. Here I have a cash flow of 4.419.65. So in that I'm going to multiply by 5%. Okay, then now I have to discount and bring it to the present value. This discounting factor, discount rate is equal to risk-free rate, which is nothing but 5%. Okay, plus the market non-performance risk, that is market risk premium, minus risk free rate, right? This risk premium, right? The risk premium is here, it is 3 point risk premium, which is nothing but 3.5%. Okay, totally it is 8.5%. So I'm going to discount at the rate of 8.5% or 8.5% for 10 years. For 10 years. Okay. Whenever inflation factors come, I'm going to multiply it, and whenever there is a discount, I'm going to divide it. So be careful. This could be a small calculation error, which, see, what happens is I'm going to put some power rates, right? Then what I have to do is, general practice, what I have to do, I'll just divide it. There you have to be a bit careful. Okay, these are small calculation areas that may lose marks, which may cause you to lose marks. Okay, then. Okay, so with this we have completed in this 1 month 3 important question also. So for the rest, we'll catch up in the next video. Thank you so much.